Good morning. On behalf of CII, I welcome you all to the CII Conference on Financial Reporting and Governance Framework. This is the first session of the conference with the theme Building Trust in Financial Reporting, the Role of Audit Committee. Well, I will not elaborate on the theme as trust, financial reporting, and role of audit committee are the issues themselves where many hours can be spent, and we have only 60 minutes for this session. And as we have eminent and learned panel with us, I will straight away introduce the panel and then hand over the session to the moderator. We have with us today Priya Subbaraman, Chief Regulatory Officer, National Stock Exchange; Rupa Vora, Independent Director on many reputed boards; Vineet Tardesai, CFO, Mindtree; and P. Kachinandan, Company Secretary and Chief Legal Officer, Tata Steel. Welcome all, and thank you for joining this important session. We also have Mr. Shamak Tata, who will moderate today's session. Mr. Tata is the chairman of the CII and National Committee on Financial Reporting, under whose leadership this conference, the first one this year, is being organized. I'm sure Chairman will cover in his introductory remarks the need and why we thought to take this initiative to have an interaction among industry, professionals, regulator, and the concerned stakeholders to deliberate upon the imperative issues on financial reporting and sound governance framework, and also engage with the government and the regulator on a continuous basis to have better and simplified regulations which can be complied in true letter and spirit. I would also like to welcome all the participants. We have 900 plus people joining this conference today. All the speakers in various sessions over 2 days, where we also will be having the chairman NFRA, Shri R. Sridharan, addressing us in the valedictory session. I would also like to thank NFCG and MCA-led initiative, CLA Online Institutional Partner, the professional firms backing the conference, and also the members of the CII Financial Reporting Committee for all the support. With these words, I welcome you all once again, and specifically to the participants, please jot down your questions in the Q&A section, which is on your top right-hand corner of your screen, so that panel, while making the discussions as well as picking up those questions and responding to your queries after the panel discussion or even during the panel discussion. So with these remarks, I welcome you all once again. And now I request Mr. Shamak Tata, Chairman CII National Committee on Financial Reporting, for his introductory remarks and for moderating the session, please. Thank you.
Thank you, Vikas. Vikas, am I audible?
Yes, please.
Thank you. Good morning. Welcome to the CII Conference on Financial Reporting and the Governance Framework. Many of you know that CII has a National Committee on Financial Reporting, which I chair, and this is the first edition of the Conference on Financial Reporting and the Governance Framework under the ambit of this committee. It's a forum where industry, regulators, auditors, and other concerned stakeholders will be closely interacting over 2 days in 4 technical sessions on the key and important issues revolving around financial and non-financial reporting and the governance framework in our country. I would quickly like to brief you on the broad thought behind organizing this conference and how we intend to keep deliberations contemporary with the evolving need of investors and financial communities. The guiding theme of the Conference on Financial Reporting and Governance Framework emanates from the fact that in today's world, there is a fast-growing recognition that owners and promoters are not the sole stakeholders of businesses, and therefore neither is profit the sole purpose. Companies now have multiple stakeholders besides the owner and promoter shareholders. They include other shareholders who have invested in a corporate's future, the lenders, employees, vendors, customers, regulators, and the government, and even the community in which the corporate operates. Trace communication, TRACE, means timely, relevant, accurate, complete, and effective is the key to stakeholder management. Communication is driven by stakeholder needs and is therefore dynamic and adapting to the changing needs of stakeholders. We need to both recognize and respond to these and deliberate on relevant issues. The conference would be an excellent forum to have an engaging discussion and reflect upon the feasible recommendations and practical solutions on few of the issues, which may need alignment between the various stakeholders, including regulators. Financial reporting, as we know, is one important communication by a corporate. We are seeing this broaden from reporting of financial numbers in boilerplate financial statements and audit reports to smooth flowing into board reports, MD&A statements, CG reports, and sustainability reporting, now the BRSR. Even auditor reports have had a facelift. Clearly, the entire corporate story can no longer be restricted to mere numbers. And CFOs, audit committees, and boards are more and more engaged in broader stakeholder communication using both financial and non-financial data points. People, planet, and profit are all now an integral part of corporate reporting requirements. In this, audit committees of listed as well as unlisted companies, and where there are none, the board, are the gatekeepers to trace communication and ensuring trust. Do we need to embrace these changes and synergize our energies in broader matters that enhance corporate reporting through enhanced governance and emerge as thought leaders? The answer is a clear yes to. Keeping these factors in view, the two-day conference will be focusing on many important issues, which are building trust in financial reporting, the role of the audit committee, the theme of this very session, internal audit in a fast-changing environment. What measures does the industry think are needed for strengthening the audit profession, and what are industry expectations from the auditor? And the fourth session, the role of regulators and the future of audit. Sri R. Sridharan, the chairperson of the NFRA, as Vikas has mentioned, has given his kind consent to address the conference. And he will be addressing the valedictory session of the conference, the theme of which would be the role of regulators and the future of audit. Each of these sessions have a definitive and special focus, and I urge you to join as many sessions as possible, especially the session of the chairman NFRA scheduled tomorrow at 11:15. Today in this session, we have the theme Building Trust in Financial Reporting, Role of the Audit Committee. We have with us a very interesting and a diversified mix of experts comprising the independent director, AMPs, and even a regulator. With this very inclusive panel, rich in experience, we plan to discuss some of the burgeoning issues, such as measures required for bringing greater transparency and clarity in the role of the audit committee, how audit committees can be made more effective in their oversight role over financial reporting, and their interaction with the board, their evolving role in non-financial reporting. The audit committee's evolving role in this non-reporting will get covered specifically in some more detail as we go ahead. The growing expectation gap, fraud and going concern in audit of financial statements, the role of the audit committee will play in this, and some of the going concern assumptions. The impact of SEBI's recent reporting obligations on the initiation of a forensic audit by listed companies. What does the SEBI requirement mean? And markets are giving a greater focus to companies that provide sustainable value creation. The need for a greater focus on the environment, social, and governance issues. Finally, new technologies continue to redefine the physical and virtual borders, including of companies. And with the increase in the sophistication of cyber risks, how do audit committees evolve to be both informed and be proactive gatekeepers? With these few opening remarks, I would love to welcome and invite the panel to share their thoughts on where we are and what excites them to be. So if I move on straight away to this panel, uh, we first have Ms. Rupa Vora. Welcome. Some thoughts from you, what brings you here, and what we will hear from you.
Thank you so much, Mr. Tata. At the onset, I would like to thank CII and in particular you and Mr. Vikas Mohan for giving me this opportunity to share my thoughts and participate in the deliberations today. Having 3 decades of experience in finance and being passionate about corporate governance, I've taken on responsibilities as an independent director on corporate boards. As a chartered accountant, you are the natural choice to chair the audit committee. This responsibility is onerous. Audit committees today need to move beyond the role of just being a gatekeeper for financial reporting and controls. Audit committees need to be more strategic in their approach, look at changing risks and opportunities, challenge assumptions, and think about what could go wrong. Strive to mitigate the risks and take corrective measures to avoid recurrence of risks, and build resilience. The chairman of the audit committee plays an important role in steering the committee to live up to its purpose. The Companies Act 2013 codifies the responsibilities of independent directors. Independent directors are responsible not just to the minority shareholders, but also to other stakeholders, including the environment. Independent directors form a majority of the audit committee, and finding a diverse mix of complementing skill sets can comprehend changing risks is the first step to build an effective committee. And it doesn't stop there. Continuous engagement and keeping yourself updated is crucial. It is deliberations like these with the participation of diverse stakeholders that helps one keep abreast, know different perspectives and latest trends. The topic today, building trust in financial reporting, is of special interest. As a wise man once said, trust is the backbone of business and ethics its limbs. The purpose of an organization is the driving force to build the culture of the organization and therefore build trust. It is with a well-defined purpose that is beyond just money making, the right intention, attention on the things that matter, that leads to the manifestation of sustainable enterprises that last. I am a firm believer of I am intention, attention, and manifestation. Thank you once again for having me here.
Thank you very much, Rupa. Vineet, would you like to share some thoughts?
Yeah, good morning. Thanks, Mr. Tata. Thanks, CIA, for inviting me for this panel and on such an important topic. As Mrs. Vora mentioned that she's an independent director, I'm on the opposite side of the table, being in the KMP. I think so. The most important part, particularly what has happened in the last 18 months, is everything has become virtual. Earlier, we as a society or as an organization, were used to seeing and getting comfortable with the things. The last 18 months have completely put us into a different perspective, both as an organization, even for the independent directors, because they are seeing all of us virtually. The auditors who probably for the first time are doing most of the audit work in a virtual environment. Everything is getting sort of uploaded into a secure data room. And from there, everything is being done. And what is important that I think so has emerged during this period of time is how do companies and the whole the audit committees, the independent directors, etc., all put together establish a credibility and trust. And the most important part I would say is more and more disclosures, more and more giving comfort to the people, all the stakeholders in terms of what they are doing, how they are doing. We normally adopt a simple principle of saying, when in doubt, go and do a more disclosure. It's better not to leave something for interpretation. And I think so that is one of the important change that has happened. This is here to stay. Even after the normalcy starts returning back, probably a lot of audit work will still continue to get done virtually. We believe that more and more disclosure, more and more governance follow up from the companies is going to set a different benchmark. This is the new normal, and we all should embrace it with the help of technology.
Thank you. Thank you, Vinit. Priya, a few opening comments from you.
Good morning, Shamak, and thank you, CII, for inviting me. Hopefully, I will be able to give a good regulatory perspective, because while the pandemic has happened, there are a lot of changes that have happened too, and therefore so from a pandemic perspective, we've obviously realized, as Vinith already said, that some of what we've been doing in the pandemic, whether it is uploading data in a secure data room or virtual meetings of boards of directors and committees. The point is, many of these practices are here to stay. Therefore, at the back of that, we've also, led by SEBI, exchanges have also made a whole bunch of changes. So why am I excited to be here? I don't think I'm going to be as eloquent as Rupa, that's for sure. I will just state my piece. The point is, one is I'm able to speak to all of you. As said, more than 900 participants have registered for this particular session. Therefore, to be able to speak to all of you directly. Also give some thoughts around what have been the key changes and what is our expectation as a regulator and as a frontline regulator. What's our expectation from all of you? Many of the companies are not yet listed, but that doesn't, which really means conferences such as these actually prepare you for the next step, as in when you would want to be part of the listed space. Lastly, I'm part of the audit committee of NSDL, and I have sort of I now realize how much I depend on my role in the audit committee for my role in the board. So audit committee, I think, is extremely important. And there's a huge growing realization that the gatekeeper role is not that simple, not anymore. It's highly complex. And therefore, if I can share some of my thoughts in terms of what deliberations are happening at the regulator, that's something which really excites me. Thanks, Shamak.
Thank you, Priya. And PK, how about your thoughts around the opening? You may be on mute.
Sorry. Yeah. Thank you, Mr. Tata, and thank you, CII, for this wonderful opportunity. We are here today to discuss a very contemporary topic of financial disclosure and the role of the audit committee. And I'm quite excited because financial reporting is one of the most important forms of continuous disclosure and is the cornerstone of corporate governance. And of course, the audit committee is one of the most important monitoring mechanism, and it ensures in effective corporate governance. So both are extremely important. As we all know, the agency perspective highlights that corporate governance deals with ways in which providers of capital to companies exercise control and advance accountability of companies' management to ensure that they get to maximize their returns. And also, as we all know, the fundamental tenet of corporation is the separation of ownership and control. And this feature actually gives rise to the agency problems. The problems between shareholders and, of course, the managers, where there's always asymmetry of information between the managers and the shareholders, and also the board of directors, actually. It is in this context that financial reporting and audit committees become extremely meaningful. Disclosures and board committees, particularly the audit committee, seek to limit managerial discretion or attempts to bring in alignment in interest between managers and shareholders. Further, these mechanisms assume even more relevance because without such mechanisms, investors may be very reluctant to provide capital to companies, which is very, very critical for deployment in business and the resulting growth of the economy. Further, generally, the capital markets regulators globally intend to maintain integrity of the markets, facilitate capital formation, and protect investors. Financial reporting and effective audit committees are fundamental to furthering these aspects of the regulatory intent. Financial reporting and role of audit committees have assumed even greater importance in the current situation. Investors today are expecting adequate, accurate, and timely information with respect to the operational and financial health of the companies, particularly due to the uncertainties brought by the COVID pandemic. Historical information probably is less relevant in the current scenario. High quality financial disclosures will not only benefit investors, but will also enhance valuable communication and engagement across economy. Transparency in financial disclosures can foster confidence among multiple stakeholders, for example, between suppliers and manufacturers, investors and the companies, which in combination will benefit all. And the audit committees actually play a very vital role in ensuring and maintaining the high quality disclosures. And finally, disclosure regime is changing. It's becoming more comprehensive. It's becoming more holistic. We are actually moving towards having greater emphasis on non-financial disclosures, disclosures with respect to strategy, risk management, ethics, compliance, environmental performance, human and social performance is becoming very vital. Boards and its committees will play a pivotal role in this transition and in shaping the future of reporting. Hence, the topic of today's discussion is very apt, very relevant, and I trust our discussions will further our efforts in strengthening the governance mechanisms in India. Thank you.
Thank you, PK. And as attendees would have now realized, an extremely diverse set of panel members. As Vikas has said, feel free to log in your questions as and when you want. We'll try picking them up during the discussion and taking it to a further level. So we have roughly 40 minutes more. And what I am going to do is, although each one has spoken about, I would think more like hitting the treetops. I want to dwell into some more very specific issues and sort of poke them into giving us their suggestions, ideas, and sharing their experiences. So if I could start with this. The audit committee is an important committee of the board, and all of you have elaborated on why and wherefore. Some say with the NRC, it's playing a pivotal role in board governance. The role of the audit committee is even codified in the Companies Act, SEBI, etc. So let me address the elephant in the room. And with our lives over the last 18 months, the pandemic, it's brought about new challenges and opportunities for managements and boards alike. We have seen and lived through new ways to run businesses. In these times, what do you think has been the most significant change in the role and the ways of working of the audit committee? Is the role transforming? Rupa, if I could go to you first as the independent director, and what has been your experience around?
A very relevant question, Mr. Tata, and I think the COVID-19 pandemic was unprecedented and it brought the whole world to a standstill. And while the environment recouped a little bit because of the lockdowns, it affected our lives a lot. The first concern was the health and safety of the staff. Employee engagement and communication was important. We had employees willing to take pay cuts and no bonuses and still stay with us. That really spoke volumes about the culture of the organization. We also had employees contributing to provide relief for those in need. Supply chains were disrupted, liquidity was a challenge, bank lines were under pressure, managing cash flows needed more attention, collections were an issue, NPAs were rising, moratoriums and policy interventions needed to be addressed immediately. Capital was in short supply, risk management took the center stage. We were meeting more often and also meeting virtually. Work from home increased the risk too. VPN connectivity, IT infrastructure, cyber risks came to the forefront. Ransomware attacks were a reality. Supply chains were to be relooked at and business models reworked. Lots has changed. Audit committees are now looking at cyber risks, technology risks, BCP and disaster recovery, liquidity and going concern assumptions, and fraud risks even more. ESG is a buzzword and is gaining more and more focus. Internal audit scope is increasing with a stress on computer aided auditing techniques and benchmarking industry best practices. Enterprise wide risk management frameworks with a periodic tooth comb review of the risks is here to stay. Audit committee agendas are more than just financial reporting, numbers, and ICFR. Ensuring that the whistleblower mechanism is operational and handling of whistleblower complaints is a forte of the audit committee. Interaction with rating agencies, more frequent interaction with auditors. Now, with the new RBI guidelines, regulations to change auditors of NBFCs every 3 years, and the restriction of NBFCs for only taking up 8 audit clients, the appointment of statutory auditors is also a concern for NBFC audit committees. So a lot has changed, and what we're doing is completely different and more engagement for sure. Yeah.
So Rupa, what I hear from you is you are getting so much more involved with activities, the sort of overlapping more into management expectations of working closely with you to make a difference. And you brought about a few very interesting parts about the IA scope increasing, internal audit scope increasing. You brought, which of course will be a part of another panel. But we spoke about cyber risk. You spoke about rating agencies, auditors, meetings, etc. All very interesting. So, if I could ask you, Vineet, on this point, are there more pressures on your time because of all what Rupa has said? How are you managing this? Do you see this greater involvement impinge on what you think is your role as KMP?
Yeah, thanks, Shamak. Honestly, I don't believe that there is a pressure on us that has increased or anything has dramatically changed. I think so. It was at least in the probably first half of the last financial year, whereby it was a change in the business model or the change in the way we used to operate. Everything needed a sort of a refresh and revisit to ensure anything that probably would have happened in a in-person environment, has that changed when we are working in virtual environment? I think so. Those questions needed to be revisited. The points which Mrs. Vora mentioned, like for a company, technology company like us, cybersecurity was one of the important aspect, and this whole business model of working virtually would have collapsed if there would have been any cyber attacks. And what we as an organization, or most of the organizations, have done is to strengthen our overall information security network. There is no perfect answer on are we ready, because as we say, the thieves are always 2 steps ahead of us. And whatever you do, it doesn't necessarily give you 100% assurance that the things are in control, but at least it gives a comfort that we are moving in the right direction. Secondly, as I mentioned, our internal financial checks and balances control policy needed to be upgraded. Not for anything else, but to see how are we giving a comfort to auditors as well as to the audit committee in terms of the processes, the documents, etc. And there's no chances of any errors in that. I think so. Those first 6 months were, and let me also put the third part. It was also important to communicate to the audit committee and bring them up to the speed in terms of some of the developments that was happening with reference to clients, the delivery model, and also to our employees. The customers were undergoing a stress, so we had to revisit and ensure that none of the customers are likely to get into a default mode. We had rather at Mindtree had launched an initiative called as Help and Grow, for some of our customers who are severely stressed in this pandemic period. We help them by giving few discounts. We give them few extended credit terms, and this needed more disclosure to be given to the audit committee, just to give them a comfort saying, we are doing the right thing. Yes, there are risks, but we are doing the right thing. As I said, on the cyber security, we had a full session from our CISO office who gave them an upstairs in terms of where we are moving with our investments, and where we would like to be in 12 months from now. So I think so more and more communication should be was the core of the things. I don't think so it was a pressure. And once with this business model actually getting established, I think so we are in a much more comfortable zone, because today when I send something over a mail or WhatsApp, etc., it gives them a comfort that there is a solid back-end documentation available, which probably was not there. And now I think so there is a lot of comfort zone everybody has entered into.
Thank you, Vineet. And I do see from what you spoke and the experiences you shared, that maybe the relationship that has evolved between core management and the boards have actually strengthened over the period. And I think the level of comfort that each derives from the other is probably growing. So I think it's quite fantastic as a takeaway.
I would also add one more thing, Shamak. Honestly, we have probably answered the question of business continuity plan for at least our lifetime. Nobody would have ever questioned us that as a company, do you have a business continuity plan? Honestly, none of the companies had this situation ever imagined their business continuity plan. So we have answered it for at least our lifetime.
Thank you. Yeah. You even mentioned in your opening remarks that, the regulator has been the front and center in making a difference in some way. Regulatory relaxations, understanding the situations, looking at making some of these changes more permanent. But let me ask you the question in the other direction. Have you seen corporates live up to all these relaxations? What else should they do?
So a couple of things, frankly. The larger corporates, Vineet and PK and others, this is a way of life. But for us, we have 1,900 companies. This is not necessarily true across the spectrum. So therefore, there are certain corporates, as Rupa has said, as Vineet has said, they've used this opportunity this pandemic as an opportunity to actually build that relationship, meet more often, discuss, differently the kind of risks, what the audit committee has in the past done, what issues they are looking at today are possibly very, very different. And therefore, some companies have used that, and we can actually see that in the reporting as well. But that's not necessarily the case across the spectrum, as I mentioned. We still have companies who take calls which are actually quite ridiculous. Fractional membership, we will have a lower number of independent directors on the audit committee, so on and so forth. So it's a half and half in that sense. The larger companies, in the first place, the rules are not for them because they're already compliant, and the companies that are less so try and find all sorts of ways and means to explain away things as why they don't have one more independent director, why it is so difficult to find somebody. The disclosures are rambling rather than being succinct. Disclosures are more, and actually, so when you think about disclosures, the way I think about disclosures is disclosures need to tell the story, not just add paper. So therefore, there are disclosures that will add paper. There are disclosures which will tell the story. So we see both kinds. But see, frankly, to a very large extent, before the pandemic, we probably did not even think that we will be able to build this level of trust and these level of relationships, working remotely. In fact, there have been times when I have actually joined meetings, and this is not about the listed companies, it's about more my company, where I have joined meetings despite being in the office. I've actually joined virtually because the impact is different. When you're sitting in a large boardroom, your voice doesn't carry, you're not able to make your point sometimes effectively. Actually, I think the virtual situation has made all our lives very different. The way we present to people also has changed. So to come back to your original question, I think the answer is yes and no. But from a regulator perspective, and I think we'll dwell more on that as we go along, there are lots of changes, whether it is related party transactions, XBRL reporting, whole bunch of things which the expectation of the audit committee is certainly going to go up from a regulatory perspective. But this is where we are. Some people have taken to the changes very positively and have engaged a lot more. Others, little less.
Thank you, Priya. And in fact, I think there are companies, therefore, that can prove that doing it right probably helps, and I think become evangelists for those who don't. Will probably be a good way to look at seeing things as we move on. I'm going to sort of take this topic of cyber, which I think Anit spoke about, I think Rupa spoke about. Everyone seems to be talking about it, and sort of move a little in that direction. And so if you can see, there has been more and more activity around financial fraudsters that seem to troll the technology highway. Not only do they target the unwary individual, even corporates have become growing victims. And online fraud has increased, whether it's even in health organizations or sale of fake products, even government schemes. Consumers have experienced an encounter rate of 69% in the past year, according to a Microsoft 2021 Global Tech Support Scam Research Report. In the US, we've seen Colonial Pipeline, which was impacted by a cyber attack, leading to panic, gasoline shortages, and immediate price spikes. Banks and other financial institutions have been imploring customers to be more wary, and each of us received messages on that account. How have audit committees and through them boards taken to this changing environment? Are there growing discussions around company practices and efforts to stay protected from this threat? Is cyber taking up more mind share at these meetings? And I want to go back to you, Rupa, to understand a bit about this, and then maybe get some thoughts from PK as well.
Yeah, I think certainly, I think in banks and NBFCs in particular, fraud risks and cyber risks take a lot of mind space. It's because of the regulatory focus and the need to protect the privacy of the customer data and the reputational risk that goes with losing that data, right? There is an IT strategy committee, and that is chaired by an independent director and lays down the strategy in line with the corporate strategy to ensure that it delivers value to the business, right? There's a cyber risk crisis management plan. There's a cyber security policy. All that happens at NBFCs and banks because the regulation prescribes it. But it is important for the members of the IT strategy committee also to understand the space and to take help from experts where necessary. It's important to build trust with the CIOs so that they are on the same page and they discuss openly the vulnerabilities, and there is an informed decision taken on the acceptable risks. While this is true for NBFCs and banks, as regulation prescribes the oversight, we have about 12 lakh or odd companies at different stages of evolution. And with work from home, increased use of technology, artificial intelligence, etc., I think there is a need to have an IT strategy committee of the board. And if it is not prescribed, the audit committee, and even if you don't have an audit committee, the board should take up that responsibility. I think social media risks also are a huge risk, and we should have a sound team looking at the vulnerabilities, plugging them, and in case of an attempted or a successful cyber attack, there should be an incident management response team that springs into action, does a root cause analysis, and plugs the vulnerability. It's important to train the staff on, and the management and the board on the IT security risks and spread awareness of cyber risks. When with a ransomware attack, if you're asked to pay in Bitcoins, there is a dilemma. What needs to be done? There is a threat of the customer data leak, and on the one hand, on the other hand, there is payments like these are prohibited under the anti-bribery and corruption policy. At such times, I think it is the culture of the organization that has to be very clear. A zero tolerance policy for bribery and corruption. You have to think of how you deal with the attack. ensure that there is no reputational damage, and also safeguard customer information. The incident response team needs to do a quick root cause analysis, plug the security loophole, even get good ethical hackers to identify the vulnerabilities and give practical recommendations on how this can be fixed. I think information security audit by external auditors is now a must, and their report should form and be used as an input by statutory auditors to get comfort on the information security risks that the corporate faces. I think these are really important.
Thank you very much. PK, I want to sort of pick your mind a little differently. You've experienced in audit committees both within India and in many looked up to geographies. You know, whether we talk about audit committees in general or we talk about cyber in particular, would you like to share some experiences of what we could learn from other geographies and what you've seen?
Sure, thank you. I think it's an interesting question, and the role of the audit committee is ever evolving. I mean, it kind of changes almost on a daily basis. Even in India, we've seen the way the role of the audit committee has changed. There's been a particular role that the audit committee used to play prior to 2013, the Companies Act coming into force, prior to the listing regulations of 2015 coming into force, and what it is today. So there's been a sea change the way the audit committees have been functioning, because historically audit committees have been focusing primarily on reviewing financial statements and financial reporting processes. But today, audit committee does a lot more things. And I think Mrs. Vora has already kind of alluded to that. And obviously, the amount of work, the responsibility, and the time commitment of audit committee members have increased manifold. Now, I think while the audit committees do extremely well on reviewing financial statements, financial reporting processes, now they are slowly moving into reviewing controls, risk management aspects. But you now have a even more onerous responsibility in terms of getting to know the cyber threat, because that's a very technical area. It's not an area that is easy to kind of crack, because that's an evolving area, and you don't know where your enemy is. And typically the cyber incidents fall under two committees. Actually, it can fall under the risk management committee, the ambit of risk management committee, because there is a business angle to that, but there is also a compliance and financial impact angle to it. So it falls with both audit committee and the risk committee. So one important aspect is it's a housekeeping issue, but it's important that both risk management committee and audit committee kind of speaks. So it's always better to have one or two members in common between these two committees, so that they actually know what's happening between the risk management committee and the audit committee, because at the end of the day, both have equal amount of fiduciary duties to the board and to the investors. That's number one. I think the second aspect where the audit committee's role has really become extremely important is with respect to dealing with frauds, because this aspect of fraud was not there prior to 2013, and now it's got codified into the law. I think that's an area where it is very, very difficult to kind of deal, and I think there needs to be a lot of awareness, a lot of engagement between the management, auditors, the audit committee members, and I think some amount of training and communication awareness creation is required as to how audit committee members need to deal with this aspect, because there is a regulatory aspect to it and there's also a fiduciary aspect to it. So I think this is an important area which has become their duty but needs probably more reflection. And the third area, of course, is the ethics and compliance, because typically the Western countries audit committees do a lot more work on anti-corruption, anti-bribery, those kind of things, because of course the enforcement mechanism of the Department of Justice in terms of FCPA is far more kind of routine than what you see in India. So, but that's an area again of importance for the audit committee. And I think as we go along, audit committees will need to step up competence in this area.
PK, this is very, very interesting in terms of the thoughts. And you know, I'm going to pick on this one word which you mentioned about fraud becoming codified and then awareness increase. You know, it also takes me to my thinking around the SEBI and the LODR requirements and what's happening there. You know, the FAQ from SEBI seems to suggest that these forensic audits are initiated with the objective of detecting misstatements in financials, the misappropriation or diversion of funds. And I'm going to keep with you on this. And would you like to share some thoughts, you know, as audit committees are the governance custodians for oversight on internal controls and appropriate financial reporting. As KMP, how do you think audit committees are going to be playing this role? What are they going to do? How is it going to affect their today's working or tomorrow's working with this codification?
Yeah, that's an interesting topic, and actually it's a very, very onerous, I think, obligation both on the audit committee and on the KMPs, particularly the KMP who is responsible for disclosure in terms of the disclosure policy of the corporation. Because what the regulator wants today is if there's going to be a forensic audit that's getting initiated to do anything with the financial statements or financial statement reporting processes, that needs to be disclosed. While disclosures are a mechanism to bridge the asymmetry of information, but premature disclosure actually can have unintended consequences. While the intention of disclosure is always good, it's to bring all stakeholders onto the same page, but the timing of disclosure is very important, because if whatever good you do, if the timing is not the right time, you know, it doesn't serve the purpose. And that's where I think for the audit committees and compliance officers and KMPs, it really becomes very onerous to judge, because it's very judgmental as to how much you will tell the stakeholders, so that you don't kind of unintentionally, kind of disturb the trust and equity that you've earned in the market. So I guess there are no straight answers on this, because I've not seen as of now. I don't know, maybe Priya probably will be in a better position to tell whether there have been any disclosures on this front as of today, but I've not seen any large corporates come out and make disclosure on this front. But it will be interesting to see how the disclosure will be crafted, because as I said, it's important to make sure that we disclose so that there's no asymmetry. At the same time, we don't create panic in the minds of stakeholders. So it's a very, very judgmental issue. And I think we will learn as we go along. And I hope the regulators and the stakeholders will bear with us, because it's certainly a learning process. None of us are experts in this field. It's certainly a learning process. And I think during the learning process, all of the stakeholders will bear with us.
PK, I don't know, at least I don't know, but I'm sure that Rupa might be more worried with what you're saying, and some thoughts from you, Rupa, on how your role will be impacted here.
No, absolutely. I agree with PK completely, because to deal with asymmetry of information, because it's sometimes lenders or even managements, you know, want to take up forensic audits to see if there are any red flags and they need to address some kind of financial impropriety. But now we'll be worried to do that, because that disclosure, if it doesn't really reveal anything at the end of the day, it just, you know, is an unnecessary disclosure and unnecessary highlighting things. So I think that will make audit committees more careful to ensure that the control framework is strong, and they'll increase their vigilance on matters relating to fraud and corruption or any other form of financial impropriety. So I just think that take it positively and, you know, instill more control so that you don't have that opportunity to have to disclose something or have a forensic audit. I think that would be the way I would look at it.
Indeed, it is a very touchy topic, and I think history often judges with hindsight, and we have to be very cautious as we navigate through this. That, as PK said, we shouldn't let hindsight come into the way of the end. So let me keep that and go to you, Priya. I mean, you've been hearing the PK, you've heard Rupa also talk about it. What's your experience from a regulatory perspective? How do you see this? There seems to be another very important communication that SEBI seems to have brought out. Communicate and tell us if you're doing something. Any thoughts?
So I understand the part that PK mentioned and Rupa mentioned also, that we should not panic the market. We should not cause unnecessary, the forensic may result in no action or the fact that management, the steps that the management took were indeed appropriate. But there is a flip side. When you start making that judgment in terms of when to disclose, there is clearly a period when you have not disclosed, which means that then it becomes the responsibility of the company, the audit committee, and everybody else to make sure that the fact that audit is happening is kept so tight and so confidential that people, because this is at the end of the day, this is unpublished price sensitive information. So therefore, the care that one would have to take in order to make sure that there's no distribution of that information, so to speak, is going to be much higher. The problem is that at the exchange side, we are also looking at trading, and part of our surveillance mechanism will always focus on everybody in the company to check whether or not they were trading by those parties, whether there was trading by under parties that are related to those parties. So that also needs to be kept very strongly in mind, because while yes, one needs to be rational about the disclosure. Sometimes it is better to disclose, honestly, because the hair that comes with not disclosing or waiting for an appropriate time to disclose might also be something that puts the company into some level of awkwardness, if I can say that. So my view as a regulator would be that it is better. Of course, audit committees need to be more careful, build better controls, and therefore perhaps obviate the need for more forensic audits. But if there is indeed a situation that has resulted that the committee or board feels that there should be a forensic audit, it is better to disclose at that point. That's one. And secondly, I just want to state a couple of more things here. There have been new departments at SEBI. It's called Corporate Finance Investigation Department. On the back of that, exchanges have set up their own department in a way, investigating listed companies for a bunch of things. We routinely receive whistleblower complaints. A lot of my team members are actually engaged talking to the companies again, asking for information on a bunch of things. So the point being that if at all the board is already aware, or the audit committee is already aware of some of these issues, and they have not disclosed, and then our questions come in, then the situation also gets a lot more difficult from an explanation perspective. So I'd really urge everybody who's hearing, who's logged in to this session, to keep all these factors in mind. Thanks, Shani.
Thanks, Priya. And then just there's been a question from the audience, which I thought is pertinent at this point of time. And it's sort of poking a little more in the direction of when audit committees decide to have a forensic audit, what role should they play? Would any one of the panelists like to take this on? Yes, Rupa.
Yeah, I'll do that. So basically, when you feel or you sense, or there are red flags or signals by maybe the external auditors, by management's not willing to give information to external auditors, frequent changes in bank accounts, weak internal control systems, significant employee red flags, like maybe a significant change in the lifestyle of an employee, expensive jewelry, personal debt, credit problems, such things, or even qualifications by auditors, some idea of some qualification that's going to come on when you have a discussion with the auditors. And when you have internal auditors, complaining about some things, or internal control lapses and some financial impropriety, I think that's when you would take up the matter forward and want to have a forensic audit initiated. So when you think that things are going out of control and there must be something, when there's a whistleblower for that matter, which kind of points out to some financial impropriety, and after doing some investigation, you find that there is a need to dig more and dig deeper, then that's when you would do, take up a forensic audit is what I would think.
Thank you. Thank you very much, Rupa. Does any other panelists want to add to this or share their thoughts?
Yeah, so I guess I agree with Mrs. Rupa on this. And by and large, any whistleblower complaint raising allegations on the true and fair view of the financial statements almost does tilt the scale towards a forensic audit, because it's going to be very difficult to establish that the financials are true and fair without going into a process will become very difficult for the audit committee, and the process that they will need to follow will necessarily lead them to a forensic audit. So I guess any finger pointing on the true and fairness of the financial statements will almost necessarily lead the audit committee to this intervention.
Thank you, PK. Vinit, you had something to add?
Yeah, Shamak, I would say while I agree with all the points that have been mentioned, I just want to highlight two or three points, which, one, I think so we need to also look at the materiality of the transaction. So for example, if it is a simple, small claim reimbursement here and there that happens, it is not a structural problem. And it's not like we have to paint every employee is also doing the same. We have to look at the core of what has caused that issue. The second aspect is, at the end of the day, we also need to remember that there are more good companies prevailing into the ecosystem who are doing the right things rather than few bad apples who are there. So you should not try to put what the bad apples did and try to implement more controls on the good apples who are doing the right thing. Rather, you should take the example from what the good apples are doing and try to implement on the companies who probably are not doing. Third aspect, I think so we should not really be differentiating between a private company, a small company, or a big company, so much market capital. At the end of the day, if you consider fraud as a fraud, right, it should not be differentiated whether. So I think so that sort of a differentiation should definitely be come out. It doesn't matter. At the end of the day, if you are in the ecosystem, you have directly or indirectly some stakeholders who are part of the ecosystem that you have created, and any irregularity that you create is going to have impact on that ecosystem. So just because you are an unlisted company, it does not mean there is no accountability for you as a private company. So I think so that sort of a Chinese wall needs to be removed. So I would say that's a few of the points which I would like.
Thank you. Thank you very much, Vinit.
Sharma, can I just add one point, if you don't mind?
Absolutely, Priya.
So a couple of things actually. So from the whistleblower complaints that we've seen, more often than not, the whistleblower is actually saying that somebody in the management is involved, or somebody who, part of the owner group is involved, and so on and so forth. We have not seen that many which sort of talks about a, completely unrelated party. Therefore, from an audit committee perspective, I think it's important to actually, if you will, ring fence some of these things before, because otherwise it should clearly not be a checkbox exercise. Therefore, there are two things which I would say. One is larger companies actually have many audit firms doing various things for them. So this whole conflict of interest has to be managed properly, and then the ring fencing has to be done in a way that makes this forensic audit, effective. That's what I would say.
Oh, I think that's absolutely valid, because the agency concept can only arise from managing conflicts of interest. Absolutely spot on. Thank you. I know that we are going out of time quickly, but I'm yet going to persist with two more questions. And Vikas, please permit me to do so. We now have this BRSR, and we had Mr. Amarjit Singh, who was the executive director of SEBI and a member of the committee on BRSR, which came up with these recommendations, share his perspectives with us at a meeting earlier. And he made it clear that money is moving towards ESG and investors are pushing companies to make disclosures which are reliable and comparable risks, and BRSR will move to discussions at the boardroom. So with this piece of moving the discussions, we've also seen SEBI looking at early adoption. And we're aware of early adopters as well. PK, I want to go to you first because the initial thought of early adoption generally arises from management. Do you see this adoption growing? Do you think it benefits corporates? Or do you think that most companies will take it as add to the burden approach? How do you react to this?
Okay, so clearly disclosures getting more comprehensive and holistic does benefit corporates because at the end of the day, all of the corporates, irrespective of which industry they are in, they operate within the ecosystem, and the societal equity is absolutely necessary for any company to do well. So whether it is equity with employees, customers, suppliers, the government of the land, um, or the investors, doesn't matter. They need to have that equity. So obviously today, I think even without there being a law, time has come that the companies need to focus on all of these stakeholders. And now particularly in India, India has gone a step ahead than its global peers. The fiduciary duties of the board have got codified, and that has got kind of enlarged. And Section 166 very clearly says that the board owes duty not just to the shareholders, but to the larger set of stakeholders. So strategically, it makes a lot of sense for the companies to engage with stakeholders and communicate with stakeholders. Legally also, it now becomes mandatory for the board and of course the management to engage with stakeholders. So I think if you look at it from a long-term perspective, it's absolutely beneficial. Probably in the short term, you'll have some teething problems. There'll be some amount of compliance cost involved. But from a long-term perspective, for companies that want to be alive, want to be sustainable, this is the way to go.
Thank you, PK. Just a quick rebuttal from you, Rupa. Do you see audit committees and boards pushing for early adoption?
I think ESG is taking center stage now, and with capital flowing to sustainable investing, it actually forces CEOs to think about it, and through CEOs, management, top down, the board and audit committees also to focus on this. And I think sustainability is the way forward. So even for unlisted companies, I think I'm waiting for that light BRSR reporting format, because I think that will really force us to think, because what we report on is what we think about. And if you may permit me, just a few initiatives that we're taking are a step in the right direction, I feel. And like allowing board meetings, shareholder meetings on video conferencing, e-voting, etc., is steps in the right direction. And I think we should extend these beyond COVID, and we should also look at replacing publishing of financial information in the newspapers with e-filing that is accessible to the public. Even minute books for that matter. I think if we have e-minute books which are secured and maintained properly, that would be a long way. That'll go a long way in having sustainability and looking after the environment. And as Greta Thunberg says, you are never too small to make a difference. So even these small steps will really help us be more sustainable. So just a few words. I think nothing more important than sustainability today.
Thank you so much for these comments, Rupa. This is interesting, and I'm sure that we will take back some of these and take them back. I'm going to move very quickly. We are 4 minutes over the hour. And I want to go to the last part of what we're going to discuss, and that's the financial reporting ecosystem. And there are a lot of stakeholders in that, in collation, preparation, and approval of financial statements, as well as those that provide external assurance. The audit expectation gap has existed for decades and been defined and described in many, many ways. One school breaks it up into a knowledge gap or a performance gap, maybe an evolution gap, etc. I want to keep corporate failures and significant accounting restatements out of this discussion. We won't finish for another hour if we don't. But it's fair to say that the trust in financial reporting ecosystem and corrective steps in all parts of this ecosystem are needed to address the crisis. The US centric NACD, that's the National Association of Corporate Directors, Public Policy Governance Survey, over half of those surveyed stated that financial stability, risk, and cyber risks are tasked to the audit committee rather than the board. And we heard PK talk about it. We heard you talk about it. We heard others panelists talk about it, how risk committees, audit committees interact, board committees play a larger role. The shift is perceptible. And therefore they're in India as well. It's important that granularity of discussions at an audit committee provide for appropriate discussions or appropriate backdrop for effective discussions at a board. Vineet, how do you think that this gap can be reduced? How can corporates help address this? And what are the roles of the audit committee?
Well, I think so. There is no perfect answer again, Shamak, on this. I think so. More and more disclosure and more communication is an important part of it. I'll just give a very simple example to the point which Rupa mentioned earlier. We at Mindtree go for a full-blown disclosure every quarter, and we have a choice to sort of go for a condense or an average disclosure. But we we have made a decision that something which is already set for as a process, as a check and balance. Our monthly closing is now so strong that we don't need to worry about going back. Right? This is taking a step back if we would have gone into that stage. So at any point of time, whatever disclosures we make on a quarterly basis is as good as you seeing our annual report without the other statutory information. But our financial disclosures are pretty, and I think so that is a good thing to have. It gives them more transparency. It doesn't tell you anything that we treat like every month or every quarter is like an annual year end for us, and that robustness that today we have has established a good amount of comfort level and a confidence level with all our stakeholders, including the audit committee or to the board level. So I think so that is what I would say is an important part. Communication, as I said, when in doubt, go and do the communication, and then you can always debate and discuss whether you want to think about doing anything differently. Over a period of time, the law will mandate you to do a lot of other things, so which is going to be catch up. Sometimes whatever you do becomes probably a sort of a framework that others can easily copy. So I would actually urge the regulators to sort of take and help from good companies, and try to set up a framework for probably the rest of the companies eventually.
Thank you, Vineet. Rupa, just two very quick thoughts from you around related party transactions. They're seen as the core component of fund diversion activities, which impact and also impact going concerns. We had examples. What actions have audit committees been engaged in to evaluate RPTs? Have this and to see that they are in the best interest of the company? That's question one. And second, maybe related, have you seen an increased communication or engagement with both external and internal auditors around this concept of the expectation gap?
To take your second question first, I think it's a yes, absolute yes, because there is definitely more engagement. Audit committees look at the certificate from the CFO to say that these are arm's length transactions and in the ordinary course of business. They look at internal auditors to give the similar, ratification that they are in fact at arm's length and in the ordinary course of business, and also statutory auditors to give a confirmation about these RPTs. I think it's very important because sometimes allocation of costs, even though they may be genuine costs, the way they are allocated is a little difficult. For example, KMP costs that are split across group companies, or an allocation of common costs, royalty for the use of brand support fees. All these need to be justified and need to be fair. So I think that is very important. And I think the recent SEBI amendments, which require 2/3 of the audit committee to be of independent directors and independent directors alone to approve related party transactions, just shows how much the regulator also wants an independent perspective on the related party transactions and whether they can justify it. With all that, I think the approach needs to be one of trust and verify, and instead of distrust and crucify, in the words of Mr. Damodaran. So I completely agree with that it needs to be trust and verify and not distrust and crucify.
Thank you. Thank you for that, Rupan, and very interesting thoughts from all of us. I know that we are over the hour, 10 minutes. I want to give each of you literally half a minute. If you could just give me one, maybe two very quick takeaways that you received from this and what you would like the audience to carry away, I think that would be great. I actually want to start with you, Priya.
Okay, so my takeaways are focus on non-financial metrics, because that is the area which will build relationships. And second, as audit committee members, more of reflection, more of awareness, a lot of time on training. So I think this is my takeaway.
Thank you, PK. Priya?
Shamak, so I think what has got discussed today, each of the subjects, as you've already correctly pointed out at the start, is worth a conference by itself, because there's a lot of work that needs to be done from a regulator's perspective. I can tell you that before the RPT regulation came into existence, there was hours and hours of discussion which happened between exchanges. Companies were invited to give their thoughts and so on. So the responsibility of the board, the responsibility of the audit committee, especially for issues which are obviously financial reporting, but non-financial issues also, including cyber, is going to increase exponentially. PK mentioned training a couple of times. I would echo that completely. I don't think my takeaway per se is it's gratifying to see this much level of discussions in various boardrooms. So that's that in a sense makes my job easier. But I will urge all participants to actually put up their hands and seek training if they don't really know it, because it's not often that audit committees understand tech architecture. Mindtree might be different, the board of Mindtree might be different, but not everybody understands that you need to understand all of these things. So our experience has been larger companies have done very well. Mid caps, not so much. So I really urge all the participants to give deep thought to training and to understand the latest risks.
Thank you, Priya. Vineet?
As I said, I think so. More and more communication, build that trust, take that extra step to, if there is a question, situation of doubt, take that extra step and communicate more. I also want to go that disclosure should not be just tick in the box. It has to be really, really qualitative part. It has to tell the story rather than the content, and that I think so is an important part. Training is ongoing. We are not experts. We should not ever become complacent with the saying, we are perfect in every aspect. Take a pat for what you do good, but think about post-COVID, 2 years, 3 years down the line, and keep on doing, thinking about it. Technology plays a very, very important role. This pandemic has shown that a lot of things could be done with the help of technology. And I would say, some of these things, the good things that we have done during this period of time should be definitely carried forward even beyond the COVID times.
Thank you, Vineet. And last but not the least, Rupa.
Yeah, thank you. I think the audit committee is not just a gatekeeper, but also the conscience keeper. Ensure that the committee is diverse and the members are committed to bringing an independent perspective. Choose the chair carefully, set the agenda to focus on sustainability. Choose the right way, even if it's not the easy way. It will do you good in the long term. And set the tone at the top. Encourage effective communication and help build the culture of transparency, integrity, and accountability. That's what I would say.
Thank you. Thank you so much, Rupa. And we really are running out of time. I just have three small parts which I took away from this conference. One is the culture of an organization is extremely critical. Second, we have started building on strengths of relationships between boards and management and keep it going. The final one, of course, is managing conflict of interest. With this, Vikas, could I please hand it over to you? Apologies for having taken more time, but I know this is a very interesting topic, and I'm sure the participants will get it.
No, I must say thank you very much. Very interesting discussions, sort of lots of foods for thought and sort of lots of learnings. I'm afraid we are completely running out of time. So thank you very much, PK, Priya, Vineet, Mrs. Vora, and of course, Mr. Shamak Tata for sharing this and for all for sharing your perspective. Thank you very much for your time. And we are immediately starting the next session, which is at 11:15 to the audience. This session is about internal audit in fast changing environment. So we'll be just taking a minute and then starting that session. So with these remarks, thank you very much to the panel one for this session. Thank you.
Thank you very much.
Thank you very much.
Thank you.
Thank you.